Hi, everyone. My name is Todd Schweitzer, the CEO and co-founder of Bronchus, and I am very excited to join the Apex Oxygen panelists and the Singapore FinTech Festival to share with you a bit of a workshop and deep dive into open finance and open banking from the commercial perspective. I think one thing I've learned working in open finance over the last several years is that there is a typical assumption that open banking or open finance practices are really a compliance exercise, because sooner or later the regulator is going to require financial institutions to provide open APIs, and so therefore it's kind of first a compliance exercise and then a business model to be kind of stitched together. I'm based here in Southeast Asia, and in most of Southeast Asia, there's a lot of open finance activity taking place, including from FIs that are making steps towards launching open finance APIs, but they're not doing so because of a compliance mandate. They're doing so because they see business opportunity in thinking in new ways about financial services. And that's what I think is so exciting. You're seeing the development of actually an open finance economy developing in Southeast Asia, particularly emerging Southeast Asia, like Indonesia and the Philippines and Vietnam and Thailand. You're seeing these models emerge where financial institutions, banks, non-banks like e-money issuers and remittance companies are finding new ways to access customers, to monetize financial products, and actually new ways to reach and repackage financial products in new and innovative ways. So that's what we're going to be talking about today. Hopefully you'll learn a thing or two about how open finance business models can be beneficial, whether you are a potential user of open banking or open finance APIs, or whether you're a potential provider of open finance APIs. I think in both ways, there's a lot of opportunity for a profitable way of working. So first off, a little bit about Bronchus. So Bronchus is an open finance technology company. We were founded in 2016, and since then we operate across Southeast Asia. So Singapore, Indonesia, Philippines, Vietnam, Thailand, and expanding very soon. And we work really on both sides of the open finance economy. We work with API providers, primarily financial institutions, that are looking to launch APIs as products. And we also provide API aggregation for fintechs, e-commerce companies, even digital banks that are looking to consume open finance APIs. And we'll get into the details of what that looks like in a bit, but hopefully that gives you a bit of an overview. I want to start by laying some context. And again, my presentation will be a bit Southeast Asia focused, but I think that's where open finance has such a big opportunity. First and foremost, Southeast Asia banking customers are underserved. In Indonesia, in the Philippines, and Vietnam, you have about 50% or less banking penetration. And of that, only a quarter of the population is even online to using banking services. Now, you could say, well, these are people who do not, expect to, know how to use or want to use financial services. But actually, I think in many cases, it is the financial institutions that consider the mass market populations not profitable, frankly speaking. They say, directly or explicitly or indirectly that, the mass market banking consumers are relatively low revenue for a very high cost to serve. And if you think of Indonesia or the Philippines, for example, these are archipelago nations. So for a population that's in a far out island province, in a traditional banking model, this means setting up branches, running cash trucks, staffing those branches, managing security at those branches. I mean, you can imagine the literal logistics operation just to support brick and mortar banking in kind of outside of city centers. So understandably, a lot of the incumbents opt out. They choose not to serve a large chunk of the population, in some cases, a majority of the population, with products that suit their needs because of the brick and mortar distribution costs. this is part of the opportunity that open finance provides in terms of changing distribution models and changing the economics of serving the mass market populations. We'll get there in a bit. I think secondly, again, just illustrative, is the financing gap for micro and small medium enterprises in Southeast Asia. And if you look at Indonesia, for example, there's actually, according to the SME Finance Forum, a $222 billion financing opportunity in Indonesia, of which only less than a quarter of which is served by the incumbents today. That gray $166 billion of capital is underserved, and how do SMEs access that? Well, they don't, and they rely on just saving up cash, or they go through the informal lenders. And I know anecdotally lots of small and pretty significantly sized businesses in markets like Indonesia or the Philippines still rely on informal lending, which can be at 20% monthly interest rates. So again, this isn't a presentation about MSME financing, but this is evidence of the lack of supply that the incumbent providers are making available to small businesses, not just consumers. Also, the cost of remittance to destination countries. Now, Indonesia, Philippines, Vietnam, these are very large overseas populations, and there are tremendous remittance flows back into the home countries from workers abroad. And if you look at this, I mean, even in 2020, the total transaction cost of remittance is astronomical. It's almost 10% in Thailand, 7% in Indonesia. You know, and you can imagine for a domestic worker from Indonesia working in Singapore, or working in Hong Kong, sending funds home, if they're netting $200 a month, and 7 or 8% of that is going to remittance providers and all the kind of intermediaries in between, that's a significant transaction cost relative to their discretionary income, and this is just evidence of how big the opportunity is for more efficient rails powered by API and powered by fintech companies that can connect directly to the financial services providers, and ideally cut out some of the hops, you know, the 3 or 4 middlemen that are involved in actually sending the transactions. So again, these are examples of just how inefficient the markets are here in emerging Southeast Asia, and it sets a background for why open finance is such a powerful opportunity in this region. So now I want to share about what is open finance. So first off, open finance is based on 2 principles. Number 1, customers should own their financial data, which means if I've been transacting for years with a remittance company or with a bank, or even with a non-bank lender, I should have access to that data in a verifiable and relatively easy and low cost, if not free, way. Number 2 is that customers should be able to access their financial products beyond bank-owned channels, which means if I have a deposit account with Bank ABC, or if I have an outstanding loan with Bank ABC, I should be able to access and interact with those accounts without necessarily going through the bank's branch or the bank's ATM or the bank's mobile app or web app, and I should be able to interact with those products and ideally do some comparison or even movement of funds or movement of data through that channel. So open finance, the definition we use at Bronchus is open finance. It's not just a set of policies or regulatory requirements. It's not just a set of products or tech. It's the technology, it's the products, and it's the policies that enable customers to securely use financial services from qualified third-party providers. So the big message here is open finance decouples the financial products from where customers access those financial products, so that I, as a customer of a financial institution, can access those products through a qualified third party and not necessarily through the app or the branch that's owned by the institution. That decoupling changes the way financial products are developed, because you can now integrate financial services APIs with third-party apps, and we'll show some examples of that in a bit. It changes the way financial products are distributed, because partners can now onboard new customers on your behalf, and we see many really cool examples of this where fintech partners of a bank or of an e-wallet or of a remittance company are doing the agent-based onboarding through their app instead of just directing customers to a landing page on the bank or the e-wallets app. And they can actually do the targeting, the marketing, the onboarding, the account servicing through fintechs that are powered by the bank or the FI's products. It also changes the way financial products are monetized. And we'll show some examples of this, but basically it allows a financial institution to create new revenue streams, for example, authentication or identity, subscription fees, usage fees, platform fees, where banks are already in Southeast Asia building basically app stores or API stores with third-party APIs that they make available to the bank customers. Now, this is not the bank offering a new set of financial products. This is the bank acting as a platform and taking a platform fee for offering third-party products to their customers. It's a very different way of thinking about monetizing bank products. Okay, so kind of one image that to kind of stitch this all together to show the open finance economy is the supply side, the API providers, and the demand side, the API users. So an API provider could be a bank partner. It could be an incumbent bank that is now launching payment APIs or account opening APIs. It could be e-wallets. It could be remittance companies. It could even be telcos that are offering account data for the subscriber as a source of alternative credit scoring, or maybe even the telco provides a credit score themselves, or the telco could provide identity data or income data or location data that helps with a financial service provider to score or to better qualify that customer for a financial product. On the demand side, you have API users. So these could be insurtech companies, these could be mobile wallets, these could be e-commerce platforms that are plugging into the bank to offer their merchants or their customers a certain set of solutions. It could be digital banks themselves, who the digital banks may be providers of the API on the supply side, but they may also be consuming third-party APIs to provide a full ecosystem of products to their users. It could be for the gig economy and gig workers, so that inside their gig worker app, they can disperse their funds, or they can apply for a savings product, or they can access some basic wealth management. There's a lot of opportunities on both sides, on the supply side and the demand side. And the open finance economy is what exists in the middle. It's enabling easier ways for API providers and API users to connect and build new products together. So some more examples of what this looks like. So on the publishing side, some of the products that are emerging are Open Finance Suite that helps customers who are API providers set up a developer portal, an open banking infrastructure, so that they can then publish and launch and start monetizing API products themselves, branded as their product. Also administrator modules, online payment gateways, so that if you're an FI, a financial institution, and you want to start offering payments acceptance directly as to your customers, we see more and more banks in particular that are bringing payment gateway solutions in-house and offering that as a transaction banking solution. And then for finance API aggregation, you see payment APIs, which could be for pulling funds into an account, for payments, for disperse, for corporates to disperse funds. This could be for statement data, for retrieving statement data from a third-party source, which could be a bank, it could be a fintech, or income prediction even, as well as third-party product APIs, which could be account opening, it could be card issuance, and there's a longer list there. So now let's get into the business case. So why is a potential participant in the open finance ecosystem, why are more and more seeing a business case for open finance? I think number one is open finance in emerging markets in particular, it unlocks foundational market opportunities. So in markets like Indonesia or the Philippines or Vietnam or Bangladesh, there is not a reliable credit bureau. And so if you don't have a credit bureau that can give a source of truth on me, Todd, as a potential borrower, then typically the lenders need to rely on bank statements as a primary source of credit scoring data. Number two is card penetration is super low. In many of these markets, less than 5% of the population actually uses a debit or a credit card. Customers rely on bank transfer to pay, and merchants rely on bank transfer to accept payments from customers. But often, and frankly too often, these bank transfers are intermediated, which means the customer needs to transfer to a payment provider. That payment provider collects on behalf of the merchant. They take a fee, they disperse that fee, or they disperse the funds net of the fee back to the merchant, which actually, if you think about it, is a product that shouldn't exist, because if the banks have APIs available, then the customer should be able to initiate and approve a payment directly from their device to the merchant, and the merchant should know which payment matches which customer order. As I said before, you have a very low banked population, unfortunately. That's partly because of the economics of onboarding and acquiring and servicing mass market customers. And so what open APIs can do is change the economics of distributing financial services and make those more accessible to lower income Filipinos or lower income Indonesians, for example. There's also no online identity database. So if in Singapore, fortunately, you have SingPass. So I, as a resident of Singapore, can easily verify my identity by authenticating and going through the SingPass approval process. But these don't exist in many emerging markets. And so there are more and more ways for financial institutions that have already done KYC to provide that KYC as a proxy, and allowing a fintech to actually skip the KYC process. We're seeing some really profitable ways that financial institutions can make KYC as a service available to third-party apps. Number two, many financial institutions on the supply side want to launch API products today, but they need help. So the banks often lack the in-house engineering capabilities. Now, they're quickly staffing up these capabilities, but frankly speaking, in emerging economies, the IT teams have focused on managing vendors and managing reliable branch infrastructure rather than a developer-first API infrastructure. So that requires a bit of a change in way of working. Local development shops and system integrators are often experienced in API products for open finance. And the large integrators like IBM or Accenture, they may charge $15 million over 2 years for a custom API development. So on the supply side, there's a lot of opportunity to provide more programmatic and productized API capabilities so that FIs can more quickly launch open banking products. On the demand side, on API aggregation, many businesses are not yet capable of integrating self-serve APIs directly. So there's a lot of demand for the products, but the businesses that would be using these APIs need technical support, hand-holding. Many businesses are looking for low-code or no-code integrations, meaning they can access these through a dashboard. And there's a lot more customer education needed on how to use fintech APIs in day-to-day operations and how to vet that those APIs are secure. So examples of how these look like are, so I'll go through some examples of what open finance products may look like today in the real world. And keep in mind that these are, these basically can span the gamut. Some of them are a single API endpoint that is very easy to integrate, and some require actually a whole product flow inside the third-party app. But I think the point is these can be really designed depending on the level of developer resourcing that the API user has. So now, some examples of how to commercialize open banking products or open finance products in the real world. I think one very clear example is retail payments. And this is probably where we see the most demand generally, because most of emerging market online commerce, customers are paying by bank transfer, meaning they are pushing funds from their bank account or from their e-wallet to the bank account of the merchant. In the US, this would be the equivalent of like depositing into an Amazon bank account in order to complete payment. And that's just the reality when the population is not carded and customers demand a low-cost way to pay using the payment methods they have available, and merchants also expect are margin sensitive and are looking for low-cost ways of receiving payment. So in the pay-by-bank model, this is the way inside the third-party app for a customer to select their bank, to authenticate, meaning they demonstrate that they are indeed customer ABC of that bank, and they approve a debit of their account and a credit to the merchant inside the merchant's app, right? So in very simple terms, this is like a link your bank, right? So you link your bank and then you can initiate a payment from inside the app. In Europe, this is an example of the PISP, the Payment Initiation Service Provider model. Now, the benefit to the financial institution, the debiting account, is that number one, they can earn a transaction fee directly that they don't have to share with a payment gateway by offering a pay-by-bank API. For the merchant, they see this as a huge benefit because even if they're paying a transaction fee, that's probably a lot less than what they're paying the payment processor to access it. And then for the customer, they're able to enjoy an instant payment that's also instantly reconciled. Another example is statement aggregation. So similar to the pay-by-bank flow, you're linking your account and then approving the sharing of your transaction data. Rather than approving the sharing, the transfer of funds, you're approving the sharing of transaction data. So there are 4 very clear steps here that are present in any flow, whether it's Bronchus or someone else. The first is you select your data source. That is often a bank that the customer is banking at, but it could also be an e-wallet like the GoPay app, or even a telco like XL Axiata or Telkomsel in Indonesia. So you select your data source. You then consent to sharing of your data, which is an important compliance step, an important security step, an important step in terms of the terms of use, so that the customer knows what they're doing. This is the difference between like a phishing attempt, you know, and true authenticated and consented sharing of data. The customer needs to know that they are approving the sharing of data. They're approving a third party to share that data on behalf of the user. And they're taking a moment to review and approve before that data is transmitted. Then they need to authenticate, i.e. they need to prove that they are indeed the account holder that they say they are. They do that typically by using the online banking credentials or some sort of two-factor token or both. And then behind the scenes, the third-party provider is sending an API request to the bank. They're sharing that, yes, indeed, Todd has demonstrated that he is indeed Todd, and that he has consented to sharing that data with a third party for a specific purpose, and then pulling the data and sharing it with the third party. Now, again, the benefit to the data source is that they can offer this on a per transaction basis. This is like a unlimited revenue usage-based SaaS product. And the thing is the data source, they don't necessarily need to share the raw data. So if you are XL Axiata, for example, you don't have to share every transaction or every phone record that the customer has used. And frankly, the customer would not want to share that anyway. What you can do is share an abstracted version of that. Are they a prepaid or a postpaid user? Is their postpaid account above a certain amount? How long have they been a postpaid user? How long have they had the same SIM or the same phone number? What area code in address do they have? Is it a well-to-do address or not? Based on their transaction volume, are they considered a high-income, mid-income, or low-income customer? The data source can choose the level of abstraction to share, and they can actually share that at different price points depending on the granularity of the data. So there's a lot of flexibility that the data source the provider can offer on a per transaction or per sharing model. Again, which can be a new revenue stream for that data provider. Another example is statement aggregation, but for the corporate use case. Now, often you think of statement aggregation or the account information service provider, AISP model, as for retail customers, but this is actually very valuable as well for corporate clients. And the best example here that comes to mind and that Bronchus uses is integration with accounting apps. So we use Xero in Singapore. Xero is an SME, online accounting app, and we've integrated our UOB accounts into Xero so that when we have a transaction on UOB, it flows directly into Xero without us needing to download bank statements and then upload them into Xero, or worse, manually key in each transaction to do reconciliation. So this allows for real-time view of cash flow. It allows for reliable access, and there's more and more tools that allow for automatic reconciliation, which is really nice for the accounting and financial operations. Authentication and identity. So payments and account data sharing, I think that's pretty straightforward. Now I want to show some less straightforward but very interesting examples, I think, of new ways that open finance can be a commercial model for financial institutions and for the consumers. So one example is in Singapore with SingPass. So SingPass is a national ID, and it's a way for you as a Singapore resident to log into government services. But more and more, it's being made available to third-party commercial use cases as well. And in this case, OCBC, a major bank in Singapore, allows OCBC customers to now sign into the OCBC app using their SingPass. So they don't need to create another login profile and login identity. They don't need to go through the full KYC process. They can actually just log in using SingPass and just have a single login. So I'm sure many of people watching have used, login with Google, login with LinkedIn. It's the same sort of flow where OCBC is making use of SingPass as a service provider so that they don't have to do additional registration and account handling for the customer. And frankly, the customer would prefer to have, fewer logins to manage. We're seeing more and more examples of this, for example, with e-wallet providers that have already done KYC. They've already registered a customer, gone through the compliance checks, and now they can offer that KYC as a service to third-party fintechs, which is super valuable because catching up with a friend running a fintech company, they told me that when they're onboarding new customers, which they have to do basic KYC, they lose 70% of their customers during the sign-up process because of the upload of documents, the KYC requirements, the review requirements. And so being able to use an e-wallet that's already KYC'd me, and then I can just log in through that e-wallet to skip the KYC process, that is hugely valuable. And the fintech is willing to pay a significant sum to the e-wallet provider in order to have their users skip that onboarding process, because really it's funnel churn that is otherwise super valuable to the fintech. Okay, so authentication and identity. Another example, this is out of Indonesia, is SME financing. So Tokopedia is a large e-commerce platform in Indonesia, and they have a number of lenders that can provide a working capital loan for merchants so that the merchants can basically buy more inventory to sell on Tokopedia. Now, everyone has an incentive to make this work because the customers want to access more products, the merchants want more inventory available, and the lenders would love to offer capital to merchants that have verified sales on Tokopedia. So what's happening here, and what I find so fascinating about this example, is you have 11 different lenders, each providing an API into Tokopedia that is allowing the merchants to choose among the lenders based on their profile and based on their transaction history. And they can apply for and be approved for financing all within the Tokopedia app. And what's cool here is you have BFI, which is typically a multi-finance, actually vehicle lending, like secured vehicle lending. You have DBS, which is a Singapore bank in Indonesia. You have Coinworks and Modalku, which are startups. You have Permata, Mandiri, and BCA, which are local large Indonesian banks, all competing to offer working capital loans, not by bringing customers to their landing page on their site or their app, but by actually completing the loan origination process inside the Tokopedia app, which is really remarkable change because they're using Tokopedia as end-to-end customer origination, loan origination. And they're exchanging data back and forth between Tokopedia. This is verified data because this is seller data that's taken place on the Tokopedia platform. So it's really an example of win-win-win for the customer, actually win-win-win-win for Tokopedia, for the merchant, for the customer, and for the lender. Where by connecting APIs, stitching them together, making them available on Tokopedia, you can actually make a much more efficient financial services marketplace at the point of interaction. So it's a really cool example of kind of open banking applied to an emerging market use case. Okay, next is the banking as a service model. Now, this is an entirely separate topic, which we don't have time to get into today. But it is relevant because banking as a service and open finance are really two sides to the same coin. So banking as a service is a model that allows third parties to connect directly to bank systems through APIs. So this allows third parties to actually build banking products, even though they're not underwriting or they're not the license holder of that product. So an example would be a fintech or even an e-commerce marketplace offering a savings account or a time deposit or even retail investment products, but they're not the ones providing that product. They're connecting to a banking as a service provider that's making this fintech available as a distributor, basically. Now, the monetization then consists of a monthly license and or a usage fee for each service, which again is a new type of business model for these banks that would typically expect customers to walk through the door of the branch or to download the banking app in order, or take a phone call from a lead generation marketer in order to access the customer. And now they're doing it not only through a partner that's acquiring the customer, but they're actually servicing that customer on the third-party app. So some examples of companies that are offering banking as a service. You have Rails Bank operating in Europe, the UK, and now in Singapore. They're providing things like payments, card issuing, and compliance as a service to third parties like Neat. That Neat is not a financial institution, but they're relying on Rails Bank's license in order to offer payments, card issuance, and compliance on their application. Cross River and Clearbank are two examples in the UK and US respectively. And these are completely behind the scenes, but they're powering the financial products that these more user-facing fintech apps are providing to their end users. Okay, so that's banking as a service. The last example I want to show is bank as a platform. Now you're seeing more examples of this where the banks are actually building an app store or an API store on their infrastructure. So they're actually consuming third-party apps or third-party APIs and plugging them into the bank app. So the bank is now a consumer of APIs, not just a provider of APIs. So Siam Commercial Bank, SCB, one of the top banks in Thailand, they've set up what's called the Easy Mall in their SCB Easy Bank app, where you can actually buy higher value products. So the first one is JIB, which is their JIB, which is an electronics store, where you can actually shop for and check out for electronics inside the bank app. Now, you may say, why on earth is a bank building an e-commerce store inside their app? Well, it's because they can offer very easy one-click payments inside the app without needing to go through a payment processor, without needing to go through third parties, without needing to do KYC. The customer can just live inside of the SCB Easy app, do a high-value purchase where they typically need to use a credit card or points or installments, buy now, pay later, or even take out a proper installment loan. And they can, or maybe they want to apply for a credit card for the first time in order to finance this purchase, right? They can do that all inside the SCB Easy app. And guess what? The options available at checkout are SCB payment options. So it's a great way to introduce engagement. It's a great way to onboard and upsell an existing customer into new products. And it just creates a lot of stickiness as well. And JIB is happy because they have a new distribution channel. SCB Easy is happy because they're able to actually generate more transaction revenue and take a larger chunk of the transaction fee relative to going through payment gateways. And they're able to do this all inside their banking app. Another example is Starling Bank. So Starling is somewhat famous for many things, but I think what entices me so much about Starling is they've been really at the forefront of building a marketplace. And in addition to offering direct banking services, they have chosen a set of third-party providers that that don't offer, banking products directly, but are happy to make value-added services like mortgage brokering or loyalty program and points redemption, or even pensions and retail investment and retirement apps and products, and make those available inside the Starling Bank app. So Starling Bank consumes an API from Wealthsimple or from Habito and makes it available so that I can link my Habito account, or I can actually apply for a Habito product inside the Starling Bank app. And they've made this available now for retail and for business customers. And what's fascinating to me about this, I mean, this data is now a bit dated, but a year ago, a third of business customers were using Starling Bank's marketplace integrations, which means, number one, Starling is generating additional revenue. In addition to transaction fees and interest income from having a business customer, they're generating platform revenue by offering these third-party apps through the Starling marketplace. Number two is you have to think that this is a tremendous lever for stickiness, so that the business customers increasingly use Starling Bank as their primary bank because they have all these integrations. And the more integrations you have, the more likely you are to stick with that one bank, because you've already plugged them into various third-party apps you use for accounting or for fraud detection or KYC or for communications. And so this is a really interesting strategy that is pretty different from your typical retail or business bank, but is a great way of thinking about open finance as a new business model by making your bank available as a platform for third-party services. So I now want to wrap up a little bit and just share a summary of what can open finance enable in emerging economies in particular. And why should an incumbent institution that is maybe quite happy, has a brick and mortar network, has invested a lot in building out their own apps, why should they be so keen to actually think about open finance products that they would make available to third party, or on the other side, consuming third party APIs and making those APIs available inside their app? I think one is allowing for end-to-end financial apps for neglected communities or the unbanked or the underbanked. So as I mentioned earlier, we have a massive population of unbanked or underbanked communities and populations that are considered too high cost to serve. By providing financial products available through API, whether that is deposit account opening, savings products, credit products, identity products, alternative data products for those populations, you then make it lower cost to serve those populations, and you can start to pull together products from different parties and make them available as a niche financial product for a specific customer group. So number one is being able to create end-to-end financial apps that serve specific customer groups in a profitable way. Number two, and we haven't covered this today, but it's something to think about, is it's a way of connecting traditional fintech to the play to earn in the crypto economy as well. Again, I think there's a whole other presentation about how open finance and crypto can come together and provide seamless onboarding and offboarding. But suffice it to say that anyone that's interacted with or owns crypto or holds cryptocurrencies knows how much friction there is to actually accessing the products or the DeFi apps that you want to access. And so by connecting through APIs, traditional financial service products with DeFi, you can actually provide seamless onboarding and abstract away all of those hops. Third is alternative credit and instantly verified data, particularly for populations that don't have a credit score or for countries that don't have a reliable credit bureau. So it provides a nicer way to de-risk certain customer groups and for customers, frankly, to shop around and actually have competitive offerings when it comes to credit products. Number four is payroll deposit switching, so that you as the employee or as the employer can provide more flexibility in how they manage their payroll and how you as the employee receive your payroll. And you can direct that how you want and have flexibility. So maybe 10% goes towards paying off a certain loan, another 10% goes towards a savings product or a retail investment product that I've set up, and of that remaining 80%, 40 goes here, 40 goes there, right? It allows for this modularity where APIs can enable kind of routing of your payroll and the analytics behind that in an interesting way. And then lastly, and I think to sum this up, it provides banking and alternative financial services for companies and financial institutions that want to compete on customer experience, not competing on the number of branches or the size of their asset base, but actually competing on providing world-class experience for a particular customer group and competing on that customer segment and really shifting towards a customer-centric model of banking, which is valuable really valuable for particularly groups that have been maybe underserved previously. So I know that was a lot to cover, but hopefully that gives you an overview of the commercial and business models available for open banking in Southeast Asia and really all emerging economies. My name is Todd Schweitzer. Thank you so much for attending today. Please reach out if you'd like to learn more about open finance, and enjoy the rest of the Apex Oxygen sessions and the Singapore FinTech Festival. Take care, everyone. Have a great day.